Have you ever stopped to think how that simple tap of your phone or, clicking checkout online, how it's been more than buying stuff, like how it's subtly rewriting the rules for whole economies, maybe even changing how governments think about money, and even shifting things for our own home? Welcome to the Deep Dive. Deep Fake, you give us, find the really important nuggets and help you get properly informed, without all the noise. So today we're jumping into some fascinating consumer trends and news. This is all from July 16th, 2025, pulled from the Consumers 360 commentary over on the Consumers.App site. Our mission really is to unpack these big shifts we're seeing in payments, in housing, even in digital currencies, and figure out what it all actually means for you. Okay, let's get right into it. Starting with something global but feels very local too. First up, a headline from Bloomberg. Australia eyes cash distribution reform as online payments boom. So down under, it's not just that people are using less cash, they're actually rethinking how cash moves around. That sounds like an unexpected kind of problem.
Yeah, it's really interesting. I mean, we all know cash use is declining, right?
Mm.
Online payments, cards, that's global. But the key thing here is how that decline shows up weaknesses in the old systems, the ways we physically distribute cash. Australian regulators are hitting this blind spot we all kind of have.
Yeah.
How do you make sure physical money, actual cash, stays available for everyone, especially folks without bank accounts or, during emergencies, even when fewer people want it day to day? It's forcing a big rethink of the whole infrastructure.
That sounds like a tricky balance to strike. You mentioned efficiency and security. Who's actually trying to manage this? Is it the usual banks or someone else?
Well, in Australia, the Australian Payments Network, SPNet, they play a big part. They're like a self-regulatory body. Think of them kind of setting the rules for payments, checks, direct debits, ATMs, EFT, POS, when you tap your card in a shop.
Right, EFT, POS.
Yeah. And their big challenge now is getting the old guard, the traditional banks, to work smoothly with all the new fintech companies to build a system that works for everyone and is secure.
Okay, that makes sense. And, well, everything digital seemed to get turbocharged by the pandemic, didn't it? How much did that speed up the move away from cash, specifically in Australia? Was it dramatic?
Oh, absolutely profound. There was this study showing something like a 47% jump in businesses digitizing after the pandemic started. Many had to scramble, move online in just a week.
Wow.
Yeah. And that rapid shift just crushed the demand for physical cash because, digital suddenly felt like the only safe and efficient way to pay for things with social distancing and all that.
So if cash is becoming the sort of logistical headache, what's the implication for something like a CBDC, a central bank digital currency? Thinking about, say, the digital euro for offline payments, how could a digital currency solve these cash problems, but maybe keep some benefits like privacy?
That's exactly what they're exploring. A CBDC, like the digital euro concept, is really compelling for offline use because it could mimic that cash-like privacy. You could potentially pay someone directly, locally, no internet needed. And you could build in things like holding limits to, discourage dodgy uses. There are designs being floated, like this payoff one, that try to tackle the tech side, making it secure against fraud, even offline. It's aiming for that sweet spot, digital ease, cash-like privacy for smaller stuff.
And what about buy now, pay later? We see it everywhere now. Services like Afterpay in Australia, they seem to explode during the pandemic too, right?
They really did. BNPL, like Afterpay, has fundamentally changed how people pay. The really key thing isn't just the pay in full interest-free part. It's how it's blurring lines between spending and credit. It's basically bringing unsecured installment loans to a much younger crowd, often before they even have a credit history.
Right.
So it's not just about debt levels. It's changing financial habits, financial literacy for a whole generation, which definitely signals a need for some specific regulatory attention.
Okay, zooming out a bit. If we connect all these dots, less cash, CBDCs, BNPL, how might digital currencies more broadly impact the Australian economy? And what are the big regulatory hurdles?
Well, the potential impacts are huge. New ways to transact, maybe better financial inclusion if done right, potentially lower costs. But it's a massive challenge to the traditional banks, their whole model.
Yeah.
So the regulatory tightrope is, how do you encourage all that innovation, but also keep the financial system stable? And crucially, how do you make sure everyone still has fair access to basic cash and that consumer rights are protected in this fast-moving digital world? It's a lot to juggle.
Definitely. And as we all use more digital payments, safety is just huge. Which brings us to our next headline from India Today. 5 key safety tips for digital payments, NPCI. So beyond the basics, what are some of the newer innovations keeping our money safe? especially with threats getting, well, more powerful.
We're seeing some really cutting-edge stuff, actually, like quantum digital payment.
Quantum, okay, explain that.
Right. It sounds sci-fi, but the idea is to use quantum tech, the same physics that makes quantum computers so powerful not to break codes, but to make them stronger. It can generate these things called quantum cryptograms for your transaction, basically an unforgeable digital signature.
Unforgeable.
Theoretically, yeah. Even against future supercomputers. It's about future-proofing payment security against really powerful attacks.
Wow, that's mind-bending. But okay, bringing it back down to earth, to our everyday clicks and taps, even with quantum tech on the horizon, personal security is still key, right? The National Payments Corporation of India, NPCI, they have some practical tips for us. What's maybe the one people forget most often? What's the real risk there?
It's often the simple stuff, honestly. NPCI lists 5 key tips, and the very first one, always verify receiver details before transferring money. Sounds obvious, but it's so easy to skip when you're rushed.
Yeah, true.
And scammers are so good now at impersonating people or businesses. Just taking that extra second to double check can stop you sending money into a black hole, basically. Because getting it back, almost impossible.
Right.
Another big one is two-factor authentication. That second layer is vital if someone does get your password. The others, using secure platforms, keeping apps updated, watching out for phishing, standard but essential stuff.
Okay, and thinking about official bodies again, how does the European Central Bank's idea for a digital euro link back to this, especially the offline part and security?
The ECB is definitely thinking along these lines. Their concept for a digital euro explicitly includes supporting both online and offline payments. And for offline, they're really stressing that cash-like privacy and local settlement, so potentially device-to-device payments, no internet needed. But they're also looking hard at the rules holding limits, strong fraud prevention. Designs like that payoff concept are part of figuring out the technical nuts and bolts of making offline digital payments actually secure and reliable.
So, with all this new tech, but also these persistent threats, what are the main risks we still need to be vigilant about on digital platforms, and what can we personally do?
Well, the usual suspects are still top of the list. Data breaches, leaking our info, those crafty phishing attacks trying to trick us, and various kinds of fraud, including potentially those more advanced computational attacks trying to break the underlying security.
Okay.
So for you, for the consumer, the actions are pretty clear, but you need to be consistent. Check your transaction history regularly, spot weird stuff early, use strong, unique passwords everywhere, turn on biometric security, fingerprint, Face ID whenever you can, and just be super skeptical of any unexpected message or call asking for bank details or login info. If it feels weird, just stop. Don't click, don't reply.
Good advice. Okay, so we've seen payments shifting, from physical notes to maybe even quantum secure digital stuff. But these money trends, they don't happen in isolation, do they? They ripple out. And maybe nowhere more directly than, well, our homes. How are these bigger economic currents affecting mortgages? Our next headline really points to this. It's from FOX9 in Minneapolis, St. Paul. Homeowners are falling behind on mortgage payments in these states. What's the story there?
Yeah, we're definitely seeing a worrying uptick in mortgage delinquencies. It seems particularly concentrated in some southern states right now, Florida, Georgia, South Carolina, mentioned here. Now, people might immediately think, oh no, 2008 again. And while there are echoes, it's important to remember the rules changed a lot after that crisis to try and prevent a systemic meltdown.
Right, the regulation.
Exactly. So this time, the impact seems more regional, hitting local economies. Think less consumer spending, the risk of foreclosures increasing, which then hits property values, maybe even local jobs.
Okay, so it's serious, but maybe not systemic in the same way. But beyond just the main mortgage payment, what other costs are squeezing homeowners? You hear about escrow payments. Are they a big factor?
Oh, a huge factor. Escrow payments, the money set aside for property taxes and homeowners insurance, they've apparently jumped by, get this, 62% in the last 5 years.
62%. Wow.
Yeah, it's staggering. And that's mostly because property taxes and insurance premiums themselves have gone way up. So that adds this significant extra financial strain every month on top of the mortgage itself. And yeah, that's definitely contributing to more people falling behind.
So if someone does slip, even just a bit, misses a payment or two, what does the research say about the long-term effects? Does this soft default idea mean it follows you for a while?
It absolutely does. Research into what they call soft defaults, maybe not full foreclosure, but falling behind shows these lasting negative impacts. We're talking lower credit scores, banks being less willing to lend or offering lower credit limits, and interestingly, even lower rates of actually owning a home again for up to 10 years later.
10 years?
Yeah. And it's not always just about individual choices. It connects back to the bigger economy. Things like state unemployment rates are actually pretty strong predictors of mortgage delinquency.
And interest rates, we've seen them rising. How does that fit into this pressure cooker? And are there things policy-wise that could help ease the strain?
Rising rates are a direct hit, especially for anyone with an adjustable rate mortgage and ARM. Their payments go up.
Right.
That means more income just servicing debt, less money for everything else, consumption drops.
Yeah.
And yeah, it pushes delinquency rates higher, especially for households that are already stretched, mid to lower income folks, policy-wise. Well, you could look at things like more proactive loan modification programs, maybe incentives for banks to help people refinance into more stable loans. Stronger oversight to catch predatory lending is always important. And also maybe boosting financial literacy programs so people better understand the risks and options when things get tight.
Okay, a lot happening on the home front. Let's shift gears for our last segment into the often wild world of cryptocurrency regulation. This headline from Barron's via MSN.com. Genius Act, Clarity Act, Crypto Week, and why it all matters. Sounds like a busy week in Washington. So what's this Crypto Week legislation aiming to do, and how might that affect companies thinking about, dipping their toes into crypto?
Right. Crypto Week is basically shorthand for this push to get clearer rules of the road for digital assets. If these laws pass, the big impact is reducing that cloud of uncertainty and risk that's kept a lot of big companies hesitant.
Makes sense.
Clearer rules could really encourage them to start using crypto more for payments, maybe finding cost savings, or even just as a new kind of investment. Essentially, it smooths the path for more mainstream institutional money to come into the space.
And what about the Genius Act specifically? How does that piece fit into the puzzle, especially around things like stable coins and keeping the financial system, stable?
The Genius Act zeroes in specifically on stablecoins, those cryptos pegged to regular currency. The goal there is to set up a really solid regulatory framework for them. Think strict rules about the reserves backing them, regular audits, transparency.
Got it. Making sure they're actually stable.
Exactly. It's not just regulation for regulation's sake. It's seen as part of this bigger effort to manage potential risks to the wider financial system and protect consumers who use them. Right. It works alongside the other legislative pieces.
Thinking back, remember Facebook's Libra project? That big crypto idea that kind of stalled? What lessons about regulation did that whole episode teach us that lawmakers are maybe grappling with now?
Oh, Libra was huge. It really threw into sharp relief some massive regulatory challenges, especially around national sovereignty, countries worrying about a private company creating a global currency and financial stability.
Yeah, I remember those concerns.
Central banks got very nervous. And because crypto is global, Libra really highlighted how difficult it is to regulate when every country has different rules. It underscored the need for much more international cooperation. It was a real wake-up call, showing how fast this tech could move compared to regulation.
And it sounds like lawmakers might be using some pretty advanced tech themselves to try and keep up.
Yeah, that's an interesting side note. Things like knowledge graphs and even large language models, LLMs, the AI tech behind things like ChatGPT, are apparently being used now. They can help organize these incredibly complex piles of information and even help draft text, assisting lawmakers in analyzing issues and writing legislation more effectively in these really technical areas.
Fascinating. Okay, last couple of points here. How do you think the big players, institutional investors, will react if these clearer crypto rules actually come into force? And shifting slightly, are there environmental worries about crypto mining that the legislation might also try to tackle?
Institutional investors, they'll likely react very positively. Clarity is king for them. Clear rules reduce legal risk, make the market feel more stable and predictable. That's exactly what big money likes to see before jumping in. So, yeah, expect potentially much more institutional participation.
Okay. And the environment.
Right, the environmental side. That's definitely a concern. Cryptocurrency mining, especially the proof of work kind that Bitcoin uses a lot of energy and has a significant carbon footprint.
Yeah, you hear about that?
So legislation is starting to look at this, maybe setting energy efficiency standards for mining operations or creating incentives to use renewable energy sources. It's becoming part of the regulatory conversation.
Wow, okay. We covered a lot of ground there, from cash disappearing in Australia to quantum payments, housing pressures, and the complexities of crypto law. We really hope this deep dive, using those insights from Consumers.App from July 16th, has given you a clearer picture of all these forces shaping our financial world. It's really about cutting through that information overload, right? Finding the insights that actually matter for you. So Thanks for joining us, and maybe something to leave you with. It'll worry, but by these payment systems, as they all keep evolving so incredibly fast, just consider this. How might your digital footprint today, every click, every tap, every single contact, how might that not pass, but actually be helping to pave the way for the financial systems we'll all be using tomorrow?